you're able to, yeah, you're able to listen to me and see the screen. Ma'am, I'll start the session.
Yeah, screen is visible. Audio is fine. Thank you, sir.
Yeah. Hi everyone. This is Mithilesh here. So sorry for the delay in the start of the session. We'll quickly get into the presentation. The major impact in income tax over the years from a cost product perspective and also from the international jurisdictions perspective for India as well as for other important economies as such has
Sir, your video is gone. Audio is not there, sir. Sir, your audio is not there, sir. Can you hear me? Hello. मिथिलेश सर, आपका ऑडियो नहीं है. Hello, is that Sudhir ji and Animisha is there?
हेलो मैम.
हाँ, आप have you informed मिथिलेश जी? ऑडियो बंद है उनका.
यस मैम, वी इन्फॉर्म्ड.
अच्छा, he is joining again or what? Hello.
हेलो. यस,
Yeah,
ही इज जॉइनिंग अगेन.
he's again joining. Okay.
यस यस.
Sorry everyone, there's a technical problem. We'll again have to wait for it. Sorry, members, we have to wait for 1 or 2 minutes. We are just starting again. Just sorry for the inconvenience.
Now is it visible and audible?
Yeah, sir, you are
Yeah.
visible. You have
Yeah.
to share the screen. Your team has to share the PPT.
Okay. Yeah. So now is it visible? Is it convenient?
Yeah.
Yeah. So from global
Yeah,
jurisdiction
your
perspective,
picture coming, PPT is not there.
I'm sharing the screen, ma'am.
Right, sir.
So from a global jurisdictions perspective and also from the anti-avoidance perspective, transfer pricing lays down the ground rules for protecting the tax revenues of the jurisdiction and enhancing the transparency and compliance as per the supply chains of each of these jurisdictions, which ensures the arm's length distribution of the profits as per the supply chain, and also ensure the technical tax transparency between the jurisdictions. So mostly wherever the global jurisdictions are concerned, wherever there is specific initiation of transfer pricing regulation, there is always a challenge that the tax and transfer pricing rules are going hand in hand, and there is efficient utilization of the tax by the governments itself. So they have kept a checkpoint in such a way that the tax declarations are happening as per the supply chain, and also have the specific transfer pricing arm's length margins as profitabilities being disclosed in each of these jurisdictions specifically. So what exactly do we do in transfer pricing? We have to ensure that there is a life cycle. We have to ensure that the entire supply chain is being handled in a way that the documentation, the policy, the intercompany agreement, the compliances are being done specifically to ensure that there is enough documentation in place, as well as the life cycle gets attracted and adopted specifically during the transfer pricing litigation. So transfer pricing life cycle as such specifically ensures that there is enough documentation in place, right from the policy, modeling, policy setting, as well as the implementation specifically, as well as from the documentation compliances at the year end, and make sure that the adjustments are done either voluntarily, or even if the adjustments are proposed by the tax authorities, there is enough defense in place. So the entire transfer pricing life cycle as such has to be maintained, monitored in such a way that there is enough specific care that is taken for the policy, to the benchmarking, to the compliances, and the year-end adjustments, and avoid any kind of disputes in the future. So if there are any kind of adjustments, or if there is a shortfall, or if there is an abnormal year in place for the company, we should seek for alternative dispute resolution mechanisms as well through APA, Safe Harbor, or MAP. So from transfer pricing life cycle as such, is there enough documentation? Are we taking care of the compliances? Are there any year-end adjustments that are required? Or are we going for any Safe Harbor, APA, and MAP? Are the important questions. From a global perspective is concerned, wherever there is evolution of M&E structures, that is right from 1950s to the early 2000s or current 2025 as well, the M&E structures have evoluted in such a way that there is only a parent and subsidiary kind of a relationship in early 1950s versus the 2020s, where the digital economy, the economies of cross-border cryptocurrencies, or digital payments, or digital supply of the services as well as goods are exactly being taken into consideration. The entire evolution from M&E structures has been drastic, and the transfer pricing regulations also have moved from one M&E structure to a multiple M&E structures across the group, where there are enough considerations from a manual specification is concerned to a global specification where the digital economy space has been taken over. So in India, the transfer pricing evolution has happened from 2001 to 2025, where specific transfer pricing regulations have been including the international transactions as well as the domestic, specified domestic transactions. The major changes and the amendments that have happened in the past and in the current income tax bills also have been significant, in the sense that wherever the income tax provisions have been amended from a transfer pricing provisions is concerned, there is evolution from 2001 onwards to 2025. There is evolution from transfer pricing, basic section of section 92 or 92F provisions, or the rule 10 evolutions from 2001 onwards to the current sections of 162, 163 and 165 in the finance bill as such. So there is quite a drastic change. However, the basic ground rules of an arm's length, basic ground rules of a tolerance range, basic ground rules of a documentation, the compliances, as well as from assessment standpoint, have been still the same. Whereas the safeguarding of the arm's length in India has been the basic criteria or the ground rule based on which the entire structures have been amended. Now, let's go into the group structures as such. Wherever there are inbound structures, there are specific captive models, which most of us would be aware of, where the software companies or the GCC centers have been established in Hyderabad and Bangalore regions as such. They work on a cost-plus model. They are risk mitigated entities. They take instructions from the parent company and they deliver to the parent company. So it's a pure cost-plus kind of a model where costs include the operating cost base versus the markup that is being determined through the benchmarking year on year wise, or through safe harbor applications guidance that is being given by the government. So most of the software and ITS companies here in Hyderabad, Bangalore operate in a space of around 15% to 20%. But the sweet spot that the government has identified for companies around 100 to 200 have been around 17% to 18%. So if we are operating at 15, what exactly are the changes that are required and safeguards that are required to be maintained for captive centers would be required to be analyzed, and the TP risk perspective has to be taken into consideration. If these centers are going for an assessment, if these centers are going for a specific criteria of TP litigation, if the TPO is determining this arm's length, they have been specifically quoting the arm's length around 20 or 22%. But now where we are operating at 15 versus the 20 or 22 is the risk criteria that we need to take care of. So either the dispute resolution mechanisms have to be taken into consideration, or the new block assessment procedures, where once the TP assessment is done, the assessee himself can go for a pickup of the block TP assessments can be taken into consideration. So most of the captive centers, the difference in the margins and specifically the functional analysis or the services that the captive centers have been providing to US are the three criteria to be taken into consideration. Whereas a third-party model, even if it is a subsidiary or a global entity, the entities have been providing licensing, software distribution, or specific services to the third-party service models in India, to third parties, where the local Indian companies are the ultimate consumers, or there are global customers to this third-party service, providing entities. So there can be a segmentation into consideration. There can be a third-party model where the Indian entities are generating the revenue from ultimate consumers and consume their operating costs and margins and send back the sales minus kind of criteria as a royalty, as a management fee, or an intra-group service, or for the capital shareholder kind of repatriations to the ultimate parent company. Now, the third model, going into the other inbound structures, there can be a hybrid structure, that is both captive segments and third-party models integrated into our company. There has to be a clear identification of the unit level segmentals, as well as identification of the cost allocations and the cost base for the captive centers on the cost plus, whereas the sales minus for the third party ultimate revenue generating segments has to be maintained very clearly. This is one of the most complicated models. However, if the cost allocations segmentals are clearly maintained, then there can be a clear identification of the cost base, and the resources and the allocations can be turned into accordingly. The R&D centers are the high-end support service providers where the markup generally is much more higher. The expectations of the markup are more and more, where the contract R&D services are being provided by the Indian entities, and hence the 15 to 18% or the 20%, the soft convert entities are expected. If at all there is a segment of R&D, if at all there is a specification of R&D, then there is heavy expectation that the markup of 25 to 30% is being maintained, and the development centers are expected to disclose an arm's length margin in India of around 25 to 30%. Now, the global in-house centers, wherever there are enough capabilities that they are becoming an enterprise kind of organizations, there can be a cost-plus model that is coming into specification, but the back office stuff versus the entrepreneurial stuff requires a segmentation, and there is enough categorization and also identification of the employees and their time being spent on the entrepreneurial segment as well as the in-house segment needs to be considered and segmented again. Going into the next models of an outbound M&E structure, the export service model, the global delivery model, and the licensing model are the most important structures that the outbound market from India to the global, especially to the US jurisdictions, work on. So again, export service model on a cost plus, global delivery model based on Indian headquartered entities can ask for a sales minus model where the foreign companies or the foreign jurisdictions work on the marketing support and Indian entities work on the technical or the specified activities which are behaving as an Indian headquartered entities. If the foreign entity is performing any kind of marketing support, technical support, or the specified activity, the appropriate margin has to be given to the global jurisdictions, and then the sales minus will come back to India. It's a reverse model from an outbound criteria is concerned. There are enough number of entities now which have set up companies in India, especially in Hyderabad, and they have the marketing support service kind of entities back abroad. Especially pharma companies can fall in this model. Distribution or licensing model, wherever India is having an entire range of back office capabilities, there can be usage of a license which can be made sure that the remuneration to the foreign license holder or the IP holder can be done on a cost plus markup basis. So cost plus is a famous remuneration methodology, but you have to identify who is actually performing the service and who is actually performing the support activity, basically in a normal layman language. And the cost plus criteria, depending on the supply chain contributions, have to be determined from a benchmarking aspect is concerned. So next aspect of key criteria for the group structuring, this is a very important slide, everyone. So depending on the business objectives, depending on the IP locations, depending on the operational supply chain that I've been talking about, there is enough criteria that we can actually distribute the profits based on these, group structuring avenues, based on these group structuring specifications in terms of the business objectives, tax regulatory, repatriations, and the litigation trends is concerned with each of the jurisdictions. But from a global criteria is concerned, most of the jurisdictions, they have fixed audit rules, they have fixed documentation rules. So transfer pricing or the global restructuring is a double-edged sword always, and it requires these criteria to be taken into consideration before taking up any kind of decision making on the group structuring. So wherever there is a permanent establishment criteria, wherever there is an effective management kind of a rule that is applicable, wherever there is withholding tax, double taxation avoidance rules, or specifications pertaining to the local laws, where there is digital service tax nowadays coming into picture, or specifically the R&D centers or the marketing support service entities. In all these structures, the common aspect has to be the supply chain and value contribution based distribution of the profits. So you have to very clearly understand from most of the criteria that the group structuring perspectives require all these aspects that are required to be taken into consideration. Now, getting into the IP models, most probably, most of us might be software companies most of us might be development centers, or most of us might be ready for a valuation transfer kind of entities as well. So wherever the IP is coming into picture, there is always a criteria of the remuneration being maintained, or a royalty being paid, or a cost plus being paid on a specific cost base. So what exactly is the difference between the development centers and licensing is development center creates and enhances. There is something called as a DEMPE function, where development, enhancement, maintenance, protection, and extraction or making use of the particular IP is concerned. But from overall granting perspective, the license holder, whereas the entity which is actually utilizing or getting the right to use the IP is concerned, will be paying this royalty or the license fee. So the entity which is the IP holder or the license holder which has actually developed would be attributed with specific margins, where the entire development or the contribution has to be remunerated back. So either it is a cost plus or a specific royalty based kind of a percentage. But whenever there is a transfer of a particular IP that is coming into picture, there is always a valuation criteria of an intangible valuation is concerned. And the transfer has to be done at an arm's length, where the entire documentation would be based on the valuation of IP and the considerations and the rights that are getting transferred from one entity to the other. So issues involving the group structure is concerned, most of it have been the evolving issues that have been there. I've just told all these issues, but these issues have been paying key criteria or the key decision making factor for most of the global entities to make sure that their group structures are at an effective tax rate which is acceptable in both the jurisdictions. It cannot be that I am using a UAE or a free zone or a particular Cyprus or a particular tax haven for making as much profit as possible front ending with the customers is concerned, and the development is being given to India with a cost plus 5 or a cost to cost kind of a scenario. So in most of these structures, the most important thing that I would like to say is a substance kind, value addition kind, and the criteria of who is contributing to the entire supply chain, and what exactly are the other parameters that are required to be taken into consideration, and whether the documentation and the compliances are being done in a proper way, and the disclosures of the transactions, the margins, and the effective tax rates are properly being replicated on paper in their tax filings is concerned. So from an India versus US criteria is concerned, most of us would know that Indian laws are a bit more complicated or a bit more stress upon the profits that are being disclosed in India. The expectations of the tax authorities have always been, in such a way that the margins, if at all you are picked up for a TP assessment, the expectations of the margins are from arm's length criteria is very high. So the governing laws is concerned, Indian Income Tax Act versus the Internal Revenue Code, where the specific transfer pricing compliances, the applicability or the audits and the documentation and the year-end compliances is concerned is clearly mentioned. But from an initiation of assessment is concerned, most of the assessment here in India happen now as on date on a risk parameter kind of a specification. But in US, there is a risk parameter, but the threshold for the audit applicability and the recurrence of audits is much more broader. They only focus on the bigger entities or the entities which are having huge global operations and having specific low effective tax rates. That has been the general trend. But coming to the documentation, Rule 10D, 3CEB, Master File, CVCR are the requirements here in India. But in the global, the 3-tier documentation, yes, it is there. There is no fixed formats, but they are having a detailed reports of Form 5471 and 5472. The expectations of the US tax authorities is the fact that you would submit the detailed TP documentation and they would give us 3 to 4 weeks time or specific timelines for submitting the documentation in such a way that once there is initiation of audit, we can prepare the documentation later. But for the purpose of the audit, whatever facts and circumstances for each year is concerned, if you are not maintaining the internet evaluation memos or the TP documentation as on the date of filing the returns or the tax returns, you will not be able to comprehend to the facts and regenerate the documentation 3 years later or 2 years later when the assessment gets fixed up. So the documentation has to be contemporaneous as per Indian Income Tax Act, but the documentation can be prepared later from a US audit is concerned. The benchmarking approach, yes, there are 6 methods in India. There are the same methods that are there in US as well, but there is flexibility of the method. You can go for a hybrid method, you can go for multiple methods in US, but generally the approach in India is the most appropriate method. The dispute resolution program, APA, MAP, appellate procedures, all these aspects are quite similar, but in US, the MAP program is most prevalent, APA program is most prevalent for any kind of dispute resolution mechanisms is concerned. From penalties perspective, yes, India is more aggressive jurisdiction from a transfer pricing is concerned, but US also levies huge penalties considering the intent and the specific model based on which there is enough evidence with the tax authority that the taxpayer has voluntarily or with an intention to avoid tax has done this kind of structuring, or the transfer pricing model has been developed in a way that there is enough evidence with the tax authority that tax has been avoided as such. So the penalties are more towards the intention and the evidence here. Even if there is a non-disclosure, even if there is any specific adjustment, the penalties go as a consequence. So these are the key important distinctions of India and US from a transfer pricing law is concerned. From key mistakes or myths is concerned, the most important criteria or the most important myths that they're prevalent in the market are the documentation. It's merely a documentation kind of a criteria. There is, there can be the policy that can be changed on a year-on-year basis based on the facts and based on the will and wish of the taxpayer. They do not consider any kind of functional analysis or the terms of the agreement or what exactly is the supply chain. They are enough myths in the market that the higher markups always mean that there is enough risk or enough R&D or enough IP oriented transactions. If you are offering anything abnormal or a huge profit in India, the tax authorities might come back to you saying that why are you disclosing such kind of profits or huge profits here? Is there any other intention or is there any tax exemption that is available? That is why he's parking the profits here in India. Are the background checks or the myths that the general ecosystem from both taxpayers is concerned as well as tax authorities is concerned. So wherever there is a category of a mistake or presumption or a myth, there is enough practical guidance also that is there from the case laws, judicial precedents, and the practical expert analysis is concerned. Always go by the criteria of the value addition, consistency in the TP policy, documenting the facts and circumstances and terms. Each year, the group structure and the specifics of the functional analysis, if they are documented and changed or adopted as per the facts and circumstances of that particular business travel of that particular year, there is enough evidence that we are documenting in the TP documentation to prove the ups and downs in the markup. If there is a consistent TP policy, the functions also has to be consistent. If there is a reduction in the margin with the same set of activities, then there might be a business restructuring risk that might be coming from a tax authority challenge is concerned. So the tax authority can immediately ask, if you are maintaining the same set of activity and reducing the margin, how come you are surviving with the same set of functions with a lower margin? Our overall criteria from a global standpoint is concerned, wherever there is a reduction in the margin with the same set of function or maintaining the same margin by exploring or providing more and more services is concerned, in vice versa situations, the tax authority can challenge the fact that your functions are not in line with the margins that are getting disclosed. It is called as business restructuring aspect. Over a period of time, we need to analyze the functions as well as the margin that is getting disclosed. All the entities evolve over a period of time from a functional analysis is concerned. So we need to make sure that the margins are also updated and the enough remuneration criteria are also being disclosed. Nature of intercompany transactions. mostly manufacturing, trading, financial arrangements, intangibles, intra-group services, reimbursements, share capital, or any kind of rental or IP licensing is concerned, are the most important types of transactions. In each and every way in which the intercompany transactions happen, there is always expectation of the remuneration. So if you see from a remuneration criteria is concerned, there is either a cost plus, sales minus, valuation, or a criteria of time and material or a profit share is getting into picture. So most of the situations, wherever there is enough remuneration criteria that is being deployed, wherever there is enough evidence that intra-group service is happening or a cross-border transaction is happening, make sure that the remuneration criteria are appropriate and it is valued and remunerated at a benchmarking arm's length or a fair market value is concerned. So these are the types of transactions that we need to make sure that they are getting disclosed, and we have to make sure that the transaction also is addressed with appropriate remuneration methodology. Coming to the compliance aspect, this is the most important aspect, where the year-end compliances in terms of the TP study, Form 3 CEB, master file, and the local files or the CBCRs are concerned. The due dates as well as the entire penalty if the compliances are not being maintained or not being filed or not being disclosed is concerned is on your screen. So most of the companies that we know that come to us after any assessment notice or any kind of litigation that comes from income tax department from a transfer pricing officer is concerned, they do not maintain the transfer pricing documentation as on the date of filing the return. So the law is very clear. It says that the contemporaneous documentation has to be maintained as on the date of filing of the income tax return. So if 3CEB, the disclosure form, or the CA audit or the CA certified form which gets uploaded along with the income tax return, has to disclose the type of transaction with associated enterprise or the related party with whom you have entered the transaction, what is the value at which you have entered the transaction, what is the arm's length nature, and how did you arrive or derive at the arm's length nature using which method. These are the 5 important or 6 important questions that we are getting a CA declaration as well as the authorized signatory from the company getting to file this Form 3 CEB. So we are accepting or disclosing a particular transaction with a so-and-so value with so-and-so group company at so-and-so arm's length, and the method is also being specified. If this declaration is going, then the expectation of the government is to maintain the TP documentation as on that date of filing. So the benchmarking, arm's length analysis, the comparable analysis, and the public domain information on the fair market value has to be maintained, and it has to be updated as on the date of filing of the return. So master file is concerned, the threshold limit is around 50 crores of the international transactions, and consolidated group revenue is around 500 crores. For a local file, the Rule 10D, the threshold limit is 1 crore. So if you are exceeding anything of an international transaction with a related party of more than 1 crore, then TP documentation gets applied or gets applicable to you. If it is a domestic transaction, when one entity is having a tax paying status and the other entity is having a tax holiday status, and if both of them are dealing with each other for more than 20 crores, the threshold limit is higher. So a tax paying unit or a tax holiday unit dealing with each other, especially from 10AA perspective or from 80IA perspectives or any kind of special tax rates or a lower tax rates for a manufacturing facility is concerned, these are the specified transactions or specified domestic transactions for whom the SDT might be applicable. So threshold limit is 1 crore, 20 crore for a TP documentation. For Form 3 CB, even if a 1 rupee international transaction is being done, or even if the 20 crore threshold limit is happening from a domestic transaction is concerned, Form 3 CB gets applicable. 1 crore is the outer limit, for the international transactions for the TP documentation, Rule 10D is concerned. From a master file is concerned, 50 crores international transaction if you are doing, then the entire sequence of the master file or the global jurisdictions, the group level information in terms of the activities, intangibles, the APAs that you have entered into, and the entire location of the IP, who has developed it, and what has been the evolution for this particular group as such, and are there any changes in the group or restructuring is concerned are the key important criteria. So it will clearly map out what are the areas where this particular entity, the reporting entity of the master file, is contributing to, and where are the other group entities, and how much is the value contribution from the other entities is concerned. So it's a group level information. So that is why the threshold limit is higher. So this TP documentation, master file, and the CBCR are called as a three-tier documentation from a global perspective is concerned. And the next criteria is the CBCR or the reporting entity, which is having huge threshold of 6,400 crores in terms of group revenue is concerned. So these companies are very, very huge companies from outbound structuring perspective is concerned, or the reporting responsibility is concerned. Most probably all the pharma giants of Hyderabad fall into this space. Wherever there is a holdco, which is a manufacturing or a IP holder or a group headquartered company is concerned, is stationed in Hyderabad or in India, and the marketing support companies are established elsewhere in the foreign jurisdictions, this particular CBCR might be applicable. There are huge penalties for non-compliance as well. So the extended timelines are December. If you see for the TP study Form 3CB, their timelines are October. The master file has a November deadline. But if you see that CBCR as such, at the December 31st, 2025 is the deadline, and the threshold limits are higher, and it will map out clearly the employees, IPs, effective tax rates, and the substance-oriented questions in these specific CBCR reporting charts. There are specific tables in this chart which ask for data which can be replicated as and when the filing is to be done for each of the jurisdictions or each of the locations is concerned. So with this particular CBCR, the tax authority will be able to identify in which location the substance is there, in which location the IP is there, in which location the employees are stationed, and what is the volume of operation and what is the profit and the effective tax rates that they are maintaining in that particular jurisdiction with a single table. So that is the objective of CBCR getting filed. So coming to the recent changes in terms of the block TP assessment, or you would have heard about the relevant changes in the relevant recent Finance Act is concerned. Whenever there is a particular taxpayer to whom the transfer pricing assessment has happened and there is assessed arm's length criteria that is already established, when the TPO determines any arm's length for an already assessed entity and the taxpayer decides that I will opt in for a voluntary TP adjustment or a voluntary TP assessment, block TP assessment for a continuous period of 3 years based on what the transfer pricing officer has already determined, then they can opt in for this block TP assessment. This particular section is called as 92 CA 3B, where the taxpayer can opt in for a voluntary block assessment, and TPO will take this into consideration and specify or check whether the transactions are similar, whether the volume is similar, whether the arm's length criteria that he has determined for the other year is applicable for these years and is being maintained or not, and he can give a clearance for a block period of 3 years is the concept. So assessee should be already adjudicated to a TP assessment. The arm's length price has to be determined in the TP assessment, and the assessee can opt in for the next 3 years or a block period of 3 years of the future from the year in which the TP assessment has happened, and they can go for a opt-in for a block TP assessment, and the TPO will check whether the transactions are similar, the volume is similar, the functional analysis is similar, the terms and conditions of the transactions are similar, and he can replicate the arm's length evaluation check for a period of 3 years, and this can ease out the entire process of year-on-year TP assessments. So why the government has come up with this kind of initiation is the fact that this is a global trend or a global initiative by most of the tax authorities, where they are doing a block assessment for a period of 3 to 8 years. So they are going for a specified set of block assessments, and they pick up and they make sure that the arm's length is determined and the assessee pays their tax appropriately for a period of 3 to 8 years. So the same concept has been replicated here. Instead of repetitive TP assessments and administrative burden on the tax authorities, and also for the taxpayers from a continuous, a torture of this transfer pricing assessments is concerned from a year-on-year perspective. They have come up with this overall solution that if you're already assessed, go for the next 3 years. If you're similar, we will leave you for the entire block of 3 years is concerned. So the implications of a multi-year ALP is concerned from a global criteria, and also from the advantages are concerned is it reduces the business burden, it eases the workload of the tax authorities, the compliance requirements and the other aspects of documentation remain the same, but the authority can do the assessment much more faster because the facts are similar and he knows what exactly he has done for 1 year. Whether it is getting replicated or not is the only check that they are going to make. And it is a very positive step, I would say. But the taxpayer's discretion is the deciding factor. The taxpayer has to opt in. If the transactions are not similar, if the jurisdiction with which they are dealing are not similar, if the terms and conditions are not similar, or the business is evolved, or there is a global decline in the overall trend, then this criteria is not applicable. For a consistent application or for entities which are similarly doing their business year-on-year basis consistently, then they can go for this kind of block assessment is concerned. When you compare the global TP versus the India TP regulations is concerned, most of the regulations and most of the criteria for the timelines and the period in which the block assessment is going to happen, how the scope of audit is happening, and also from a dispute resolution mechanism, if the block assessment is not in our favor, then what exactly are the criteria are mostly similar. However, the key aspects for India's block assessments versus the global TP block assessments are concerned is that the assessment within 2 years from the end of relevant assessment year, that is the period which is the proposed consolidated assessment, the timelines for audits are 2 years, whereas for the foreign jurisdictions, it is mostly 2 to 4 years for US and UK. But there are enough jurisdictions which have spread it across for 4 to 8 years as well. They're going back from an investigating standpoint is concerned. So widely, if you're picking up a particular block assessment or a criteria or a block period of 2 to 3 years, then the entire scope of audit is depending upon the multiple years audit being done in a consolidated way. So this is the major advantage. But from global criteria, they have picked up a very good leaf, I would say, from the global book of TP assessment. But the way in which this will get implemented and the way in which the criteria would be done are the important practical questions are still yet to be answered, still yet to be clarified, I would say. So there are enough practical issues that I would want to highlight here. When there is a filing declaration of the block assessment, the timeline, procedure, forms, and the relevant aspects have not yet been clarified. Whether the taxpayer can go for a withdrawal after filing of this particular block assessment is yet to be clarified. Single transactions or multiple transactions, if at all, India-US cost plus 15 has been determined as cost plus 17. Whether the Indian entity tomorrow it deals with UK or with Germany or with any other EU region kind of entity with a similar transaction, whether the same criteria is going to be applied or the tax authority would say that the jurisdiction is different, transaction is similar, cost plus is similar, but I am not going to accept because the jurisdiction has changed. So single transaction versus multiple transactions is still a parameter that they have to clarify. The most important thing from APA standpoint is concerned, block assessment eligibility for assessees with pending APA cases is yet to be clarified. There are enough criteria where the compliance still remains the same and you can go for either safe harbor or APA. So if it is pending, can I go for a block TP assessment is the question that is yet to be answered. Because APAs are taking a timeline of more than 3 to 5 years criteria, this block assessment period can immediately be taken over with 1 year already being assessed by the tax authority and the next 2-3 years being falling under the block assessment criteria. Whether they can go for this block assessment during the APA application or pending applications is a next matter of concern. The TP documentations or compliance aspects remain the same, but the benchmarking update from a year on year is concerned. the tax authority, since he has determined the arm's length for year 1, can he apply the same benchmarking result, or is there any update required from a multiple year comparable study is concerned from his arm's length perspective, and whether he is going to update the search for the next 2-3 years of block assessment also needs to be established and clarified. So these are the major practical issues that we might face during this block assessment periods, and all these criteria are yet to be answered by the government. So I'll quickly tell you about the changes in the safe harbor rules as well. Safe harbor application is a dispute resolution mechanism where the tax authority is approached by the taxpayer stating that, yes, I have applied for the for a particular period where I am complying with the margins that are specified in the safe harbor notification. Example, for a software company, the safe harbor notification or the rule 10TA or the form or the notification that comes year on year specifies the margins that are required to be maintained. So if you are around 100 crores, if you are around 200 crores, the margin expectations have been 17 or 18. But there are specific amendments or expansions that are planned in terms of the definitions as such for the the rules and regulations, and there are specific definitions of ITS, the R&D centers, pharma, guarantee, loan, and other transactions that are specified in the safe harbor notification. If you are falling within the definition of scope of services, if you are maintaining the margin that is specified in the safe harbor notification, then you can go to the authority and apply for the safe harbor and seek for a complete freeness or freedom from the transfer pricing assessment is concerned. So you will be completely safe that I'm maintaining this margin, I'm falling within this arm's length, and if you get a safe harbor order in your favor from the transfer pricing authority, then you are no longer subjected to the transfer pricing assessment for that particular year. So earlier this used to be for 3 years, now it is specifically for 1 year, but the recent amendment only focuses on an additional lithium iron batteries being included in the definition of auto core components. There is not much expansion on any other definitions, but specifically if you ask me, there is every need that the ITS and other service lines are expanded and included, and there should be an inclusive definition for the definitions is concerned, for the function analysis of Indian capital service providers is concerned. And safe harbors have been the most effective in terms of cost, in terms of timelines, for us to get validation from the tax authority himself, saying that there will be no transfer pricing assessment for this particular assessment year is concerned. From a bill perspective, there has been a recent income tax bill also that has been pronounced. There are minute changes in the scope of the transaction, associated enterprise, and the way in which the tolerance range is being deployed. But I don't see a significant transition or a change that the tax authority would be deploying from a transfer pricing angle is concerned, from a concept or from the expectation of the arm's length base rule is concerned. So tolerance range, earlier there was no specific indication that a single point arm's length can be determined. Now they have made it inclusive. Now they have said that even if it's a single point arm's length criteria, we can go for the arm's length determination based on that single point criteria. And they have made sure that there is no gap in the application of the tolerance range in the interpretation perspective is concerned. So coming to the other aspects of the international transactions, they made it as an inclusive list. I would have showed you in the initial part of the presentation where there are different types of transactions that are being done cross-border. So for defined international transactions, they made it as an inclusive list. And there is a requirement that for an associated enterprise or for a related party to satisfy, there has to be one non-resident associated enterprise or a related party on the face of the transaction. For you to specifically get into an international transaction definition, one party should be a non-resident. That is specified because of the fact that majorly there are direct and indirect deemed international transactions that are being taken place. And for international transactions, specifically from a transfer pricing perspective is concerned, they have made sure that at least one non-resident AE is there in the scope of activity so that they tighten the scope and ensure that there is cross-border applicability of this transfer pricing regulation is concerned. From APA standpoint, once there is a APA signed and formally executed as per the rules, the clarity and certainty of the arm's length is being derived at. This is one of the dispute resolution mechanisms that I was talking about. APA, you can approach the tax authority, a block period of 5 years or a rollback of 4 years, conclusive period of 9 years can be adopted, and it can be replicated to the authority, APA authority, saying that you tell me what arm's length needs to be maintained for my set of activities, and this proposal can come from the tax authority itself. So this is a famous global dispute resolution mechanism. So the old, APA provisions had an ambiguity saying that if the APA application is pending, if the APA is not yet closed, whether the explicit application or the rules and regulations or the assessments are going to be continued or they are not going to be continued. So they have specifically said that the proceedings remain pending until the APA gets closed. So this plugin has been made by the income tax bill proposal as such. So mostly there is extended scope, expanded scope, structural formatting that is done, or phrases formatting that is done, but the clarification as such or the base rules as such have not changed. So coming to the domestic transfer pricing litigation cycle is concerned. So wherever the transfer pricing officer issues the transfer pricing order, what exactly happens after the transfer pricing order or the assessment order is, there are two ways in which you can deal with it. One is from the dispute resolution panel application, and other avenue is going to the CIT appeals. Here, the transfer pricing assessments are done physically. It's not a faceless mechanism. So there is a specified transfer pricing office here in Hyderabad in each of the cities of India, and you need to go and physically represent and give the submissions and take the physical hearings, and also have the show cause notice representations and the final hearings also concluded physically. But the point is, once the transfer pricing authority gives you any arm's length or a specific assessment order is concerned, there are two avenues in which you can proceed with it. Either you can go for a DRP or for a CIT appeals. CIT appeals again is physical here in Hyderabad or in the respective cities. There is a specific notification which talks about the physical CIT appeals for transfer pricing and international tax matters. So from CIT appeal standpoint is concerned, there are pros and cons for each of these routes. So once the DRP is approached, there is a fixed timeline of 9 months within which the DRP has to give you the DRP directions, and there is no 20% minimum demand payment that is required to be made. These are the two important advantages from a DRP is concerned. But DRP panel as such in the last 5 to 6 years has not been providing any kind of positive direction, because of the fact that there was an amendment in the Income Tax Act which specifically said that even in any favorable direction which is given by the DRP in favor of the IACC, the department cannot go on an appeal. So it has tied down the hands of the DRP panel, and hence most of the provisions or most of the DRP directions in the past 5 to 6 years have not been favorable to the SEC. They have mostly been neutral, or they have been continuing the same adjustments that have been done by the transfer pricing authority. But from the other side is concerned, CIT appeals, even though it is physical and there is enough lag in the process of getting into a final conclusive CIT appeals order, it takes almost around 2 to 3 years. But from a directions angle is concerned, and from the positive or negatives of the result is concerned, if you compare the positives and negatives percentage of the results is concerned, CIT appeals has been more effective in the last 5 to 6 years as compared to the DRP. So first appellate mechanism is either CIT appeals or DRP. You can go in either or routes. And the second appellate authority is similar to the regular litigation procedure of Income Tax Appellate Tribunal, then High Court and Supreme Court. The timelines are 60, 120 and 30 days, 90 days. But from overall criteria is concerned, if you compare the regular litigation mechanism versus the transfer pricing litigation, DRP is the alternative route for a first appellate mechanism is concerned. So I will quickly tell you around 8 to 10 topics of litigation and then maybe conclude with the strategies. So the 10 topics are as follows. One is characterization of the comparables. Whenever you are picking up the TP documentation or whenever you are updating the documentation of the comparables, if the appropriate comparables are chosen by you as per the facts and circumstances that you believe that the turnover, the functions and the relevant services are similar, when you are picked up for a transfer pricing assessment, the TPO has been selecting high-end companies or high-margin companies as comparables, and there has been enough litigation on IT, ITS sectors especially, stating that there is cherry-picking of comparables that is being done, and there is enough judicial precedent that are there which state that the comparables always have to be similar in the same space, in the same delivery of services. Product company cannot be compared with the services company. IP license company cannot be compared with the normal, product modulation company. And there is enough, litigation on the turnover and the range of operations is concerned. Giant company cannot be compared with the pygmy company. And there is enough segmentation and alternate services. If it is a multi-domain kind of a company versus a captive company. So there are enough differences in picking up of the comparables. So this space requires attention. This space requires much more specialized focus on picking and choosing of the comparables. And whenever there is a submission that is being made to the tax authority, you have to have enough backup of the accept reject matrix as well as the specifics of choosing the right comparable and also having an answer tomorrow of why I did not choose this comparable and why the tax authority is pushing it at us. And we should have enough evidences to prove that this is not at all comparable to our company. So there are enough deemed TP amendment provisions where the omissions from inception is concerned. Wherever there is a 92BA kind of situation, each of these jurisdictions or each of the specifics of the specified domestic transactions is concerned, one unit having a tax paying status and the other unit having a tax holiday status has always resulted in a speculation of parking of profits is concerned. There is always a specific criteria with which there is enough high margins that are parked in a low tax or a free zone or a SEZ or a 10A unit is concerned or a ATI unit is concerned, and there is low tax or a low effective profit disclosure in a tax paying entity is concerned. So these criteria have to be matched in such a way, even if there is a high profit, low profit or a normal profit, how exactly are the intra-unit or intra-group transactions are being mapped to each other. So there is always a specific way in which the forms, that is form 56F or a 10CCB disclosure of the unit results is concerned, is to be mapped, and the specified financials of that particular tax-free status company has to be maintained, and also has to be justified tomorrow why there is high profit, why there is low profit. Criteria are to be answered. So enough appellate forums have adjudicated this particular fact, and it requires enough attention from our side is also concerned. From marketing intangibles criteria is concerned, wherever there is a foreign brand for which advertisement, marketing and promotion is being done by the Indian entities, the tax authorities have been expecting a markup on that particular cost being incurred, and there is enough service that is being done to promote the foreign brand. So there has been a bright line test concept, there has been an AMP issue, there has been a lot of criteria with which the tax authorities have been coming back to the Indian entities stating that why are you promoting a foreign brand without a specific remuneration? So wherever there is an advertisement, marketing and promotion criteria, we should be very, very specific in terms of adjudicating that matter with the appropriate remuneration methodology, and make sure that my spend is not exceeding a limit or in comparison to the market companies, in comparison to the third party companies. I'm not spending excessive or unreasonable, and for whatever I am spending in India, I'm getting an arm's length criteria of remuneration on that particular spend or service. From a guarantee standpoint is concerned, wherever a corporate guarantee is provided by an Indian parent to a foreign subsidiary, there is expectation from the tax authority that there has to be a arm's length guarantee commission that needs to be charged. So this particular aspect has been highly litigated, especially in Hyderabad. Along with guarantee receivables is another aspect where there is enough expectation of the commission or interest or a remuneration mechanism. The tax authority's standpoint has been that once you are taking up the risk, that if the other entity is not paying me, or if the other entity is not making good of the loan that is taken from any bank or a financial institution, I would be paying it as a parent entity, is the guarantee that you are providing as a corporate guarantee or as a documentation that is being given from a guarantee perspective is concerned. In an independent scenario, if any banker or any third-party institution is providing this corporate guarantee or a letter of credit, they would be charging certain guarantee commission charges. So this expectation has come from that standpoint that you are carrying a risk and you are maintaining that particular line that I'll pay if the subsidiary is not paying. Then in such circumstance, what is the remuneration that the Indian entity should get back to India, and whether that is 0.25 to 2% or 0.5%, that has been litigated very widely at the judicial precedence level. So this litigation also is prevalent, and this should make sure that the margins or the commission rates are appropriately benchmarked, and we have enough background and justification to those kind of arm's length corporate guarantee commission rates. From the interest on receivables or any kind of delayed receipts is concerned, we all must be knowing that there are outer limits of 6 months, 9 months from FEMA or GST rules is concerned for any kind of invoice that we raise, or any kind of collection criteria as an outer limit is concerned, from realization standpoint is concerned, from remittance angle to back to the Indian entities back to India. So there is no such specified timeline from income tax standpoint or from transfer pricing standpoint. However, there is often a period of 30 to 90 days that is determined by the tax authority, that is transfer pricing officer, and he makes sure that whatever invoices that are being raised are collected within a specific time period of that 30 to 90 days. Mostly for software companies and ITS companies, they have been giving 30 days as the outer limit. But for manufacturing companies, they have been specifying around 60 to 90 days as well. So if a software company is raising an invoice and is not collecting within 30 days timeline, then they would be charging the interest on the excessive credit period that is being charged. Most often, it has been LIBOR plus 200%, even at the appellate forum levels. But that LIBOR might most probably move towards the SIFOR aspects, and the tax authority or the taxpayer fight, where SBI PLR versus the LIBOR plus 200 fight has always been going to the appellate forum level on this particular topic. And it has been settled at LIBOR plus 200 or SIFOR now at 200% basis points. And the interest rate has been charged on the excessive credit periods as such is concerned. So keeping a track of the receivable and the invoice and realization credit periods is very important. So the other important aspect is economic adjustments. Wherever there has been specific capacity utilization issues, depreciation, volumes, and there is enough credit period risk or a working capital risk or any kind of abnormal circumstance which needs to be addressed through a risk adjustment, taxpayers have been applying for specific economic adjustments to the tax authorities, saying that I had a very bad year because of so-and-so reason. I have a season, I have a specific, a reason why I couldn't achieve my optimum utilization rates. There is a bench that is sitting. I am paying fixed costs just for the maintenance of the business is concerned. You cannot expect 20-25% on that particular cost. So you have to bifurcate the specific economic adjustments, bring both the TPO's comparables as well as our arm's length criteria at a level playing field, and address the situation by deploying risk adjustments or economic adjustments in such a way that both our facts and also the arm's length criteria expectation of the tax authority is on the level playing field. So these economic adjustments have not been materially accepted by the tax authority in a regular pattern, but in most of the scenarios at a higher appellate forums or at tribunal or at a high court level, the Rule 10D AE has always been accepted. And if you are at a loss-making situation, or if you are at a very lower profit criteria is concerned with the when compared to the expectations of the tax authorities, these economic adjustments and the documentation calculations with proofs and evidences plays a very vital role in justifying our arm's length nature. From a litigation trend criteria is concerned, any kind of expenditure, yes, commercial expediency is very much required, but the kind of benefits that we are, receiving versus the documentation and enough proof that actually value addition has been provided for any kind of expenditure that the Indian entity is incurring is the key criteria. So wherever there is enough rational or legitimate business expenditures that are being incurred, the tax authorities have often been questioning, why are you paying this management fee? Why are you paying this, shareholder cost sharing kind of arrangements? What exactly is the value addition that you have derived? So this benefit test documentation and proof of the rationale of the legitimate business expenditures have to be maintained, and there has to be documented and submitted to the tax authorities whenever being questioned for. So this is one of the important, benefit test criteria that are being questioned, or compensation on the other side is also being questioned. So compensation for intra-group services, benefit test criteria, documentation, the arm's length. If you are providing any kind of true up on the intra-group or a cost sharing criteria, what exactly is the value addition that you are receiving, and what is the markup? The justification of the markup is also very important. The emails, the time spent, the cost driver allocations, the value addition documents, increase in turnovers, decrease in the cost optimizations, and also sharing what exactly the profits were before and after this intra-group service receipt are the most important criteria where the documentation can be maintained. So penalties, they have been levied as a consequence of the TP adjustments whenever they are being maintained. But if there is no disclosure, if there is no documentation around a particular transaction, obviously the consequence of penalty levy is there in India. But if you are able to justify and prove that there is enough documentation that is being maintained and provided to the tax authority, then you can get away from this penalty. It's a consequential matter, but however, the entire documentation that is submitted has to be proved that it is substantive. It cannot be said that, these are the documents and there cannot be anything more than this. So it has to be substantive. It has to be a very exhaustive documentation for the proof of the arm's length nature of the documentation. Reimbursements is concerned, the next transaction, wherever there is specific criteria of cost to cost versus cost plus, there has to be a question of value addition, whether a particular transaction is being dealt with as a mere administrative convenience transaction, or is it being done on a value addition based transaction. The tax authority's argument always has been that in a third party situation, whether this service of providing this as a reimbursement or paying on behalf of the third party or paying on behalf of the related party is being done, can be done by an independent third party service provider? No. So they are expecting a cost plus even on the reimbursement administrative convenience transactions. But if you prove that there is no value addition and there is enough timeline within which these reimbursements are paid, and there is enough proof of the back-to-back invoices of the third party costing that is being paid on behalf of each other, then there is every chance that the tax authority might agree that there is no value addition and there is enough proof of back-to-back documentation. So cost to cost reimbursement payment can be accepted. Otherwise, they will always question on why not I should charge the cost plus even on the reimbursements is concerned. So coming to the last slide, I'll stop the presentation here for the question and answers. But from a practical strategies of managing the entire TP risk is concerned, there are 10-point formula. We have to maintain a detailed, robust documentation. We have to have the functional and risk alignment going hand in hand and has to be documented in the TP reports. There has to be enough updated, reliable, and up-to-date benchmarking analysis that requires to be maintained from a comparability angle for the transfer pricing documentation is concerned. World over, there is push towards substance over form. You cannot say that I'm not providing the service here, but I will receive the remuneration. in X folds. So you have to have enough employees, enough assets, enough documentation, and the office space and the delivery of services to prove why you are receiving particular remuneration. And on vice versa situations, if it's a tax holiday or a free zone or any kind of low tax jurisdiction, there cannot be a high volume of profits parked there in such jurisdictions or such units with minimum operations. So substance over form, value addition, and enough proof that delivery is happening, and with volume justification, it has to be addressed. So from a safe harbor, APA, or any kind of dispute resolution mechanisms is concerned, if you have a doubt or if you have a question, always go for the proactive approach of approaching the tax authorities, in the sense that you will be approaching the tax authorities immediately after the year-end criteria is concerned. So safe harbor eligibility, from a definition, application of safe harbor, and getting the order within the timelines of the tax authorities or the tax transfer pricing officers is concerned, is a very, very important and cost-effective mechanism from a safe harbor angle is concerned. Segment and related transactions, you have to maintain the segmental reports, you have to have the enough cost drivers, you have to have the criteria in which the time allocations are being done, employee identification skills are to be maintained right from the payroll level, project level, and the cost drivers have to be maintained in such a way that the segment reporting can happen for both captive, third party, entrepreneurial, license, software division, software support divisions, etc. is concerned in a single P&L. So conducting annual health checks, just not internal audits, just not statutory audits, the TP audit or a health check or an updated transfer pricing mechanism as on the date of filing this tax returns is concerned has to be conducted. So this is very, very important for you to evolve as an entity from year on year criteria is concerned. If international jurisprudence is required or justification is required, then bilateral APAs or mutual agreement procedures can also be adopted for if you are under transfer pricing litigation and if you have the belief that this margin proposed by the tax authority is not as appropriate as per the operations of Indian entity or the US entity. Implement the corporate governance from a TP standpoint is concerned. Nowadays, all the SEBI regulations, Companies Act, and customs and other requirements from related party justifications is coming into picture. So you have to comprehend, compile all the related party transaction provisions, not just from income tax and transfer pricing is concerned, and have this corporate governance documentation maintained from multi-law or jurisprudence is concerned, and it has to be maintained as per the provisions of each of the relevant acts. So audit readiness is always required. So once the transfer pricing audit notice comes, the entire assessment can be finished within a matter of 9 to 10 months from the date of the notice. So before submitting any of the documentation, if you are able to check the audit readiness and check the documentation and check the defense strategy or the questions that can be expected, that will save a lot of time and effort from the transfer pricing teams or the tax teams is concerned. So with this, I'll conclude the presentation here and I'll stop for the question and answers. If at all any questions can be addressed, I'll be more than happy to address the same.
Yeah, thank you so much, CA Mithilesh Reddy Garu. We are really thankful to you for such a detailed presentation and so much information for our members. That was very, very, I think, educative and informative. We have requested our members to post their questions in the Q&A box, and I think Sudhir ji has already answered a few questions. So I request the team, if you like to take some question, Mithilesh ji has to give some information.
So there are only 3 or 2 questions that I see. So how do we treat the sourcing of the Indian entity in India, buying parts in India and exporting to US? What is the markup on such manufactured parts shipped to India? So it depends on the industry. So if it is an automotive industry, if it is an electronic industry, if it is specific to any kind of steel or any other kind of infra kind of support kind of manufacturing parts. But specifically, the range in which the markup can be, deployed for this manufacturing parts is somewhere between 3 to 8% or 3 to 10%. So it depends on the industry in which the outsourced buying and supplying sourcing activity is being conducted. But if the specific industry can be addressed, and if the specific parts on which we are discussing is, can be let us know, then we can appropriately guide you. So the range generally is between 3 to 10. And if it is a very, very scarce product, and if it is a very, very abnormal range, I have never seen something touching even more than 10 to 12. That's the outer limit, but 3 to 10 can be considered as an appropriate range on the markup that can be deployed. What are the approximate costs of benchmarking reports if we are starting a new subsidiary? It depends, sir. So if you are doing a 3-year, multiple year documentation from 2 databases, approximately it might cost you somewhere around 1.5 lakh to 2 lakhs is the approximate costing. But the number of transactions that you are conducting would be the next question. If you are having only software support kind of services, it's a single transaction, so it might be done within that 1.5 to 2 lakhs. But if it is multiple transactions like licensing, share capital, any kind of management fee, or cost sharing criteria, if you have domestic transactions with third party internal benchmarking, all these complications might be there. If the facts can be specified, we can support you on the benchmarking, but generally the cost is around 1.5 to 2 lakhs.
So
Yeah.
I think rest is the compliments that they have given. Thanks for the
Thank you so
session.
much. Thank
No
you so much.
question, excellent session. And thank you for the informative session. So members have really complimented for the session. Thank you so much, sir, for so much information. There are questions which are already answered by Sudhir ji. So it is 8 questions in answered thing. I think members have already got their answers, and is there any other question you want to put? Any other?
I think mostly everyone are asking about the arm's length ranges and the specific markup numbers. These are only an approximate numbers that generally the industry works on or our experience. But if the specific facts and circumstances are not matching, and if there is any abnormality in the assumption based or general experience based answers that we are giving, it cannot be taken as the justification. So please specify the facts and take relevant advisory and take the documentation, and then only it can be said that it's absolutely clear. So I just wanted to make this caveat. Thank you. Yeah.
Yeah, thank you. So I think there's no more questions. Mostly questions were answered, and the rest you have already clarified. Thank you so much for this elaborative session, sir.